The first and most unbreakable law of risk is simple. Never commit maximum size to an uncertain setup. Uncertainty is the great destroyer of capital and the silent killer of conviction. I have watched fortunes evaporate because men were too arrogant to admit the chart was still asking a question. You must learn to trade with humility, understanding that the market owes you nothing but the truth you extract from its price action. If you initiate with full size into an environment you have not yet proven, you are already accepting ruin as a potential outcome. The true professional protects their capital first, and only then seeks opportunity. The tool of the disciplined professional is the 1/8 position. This is not some arbitrary percentage from a spreadsheet. It is the calculated minimum risk necessary to gain observational control over a potential move. The 1/8 size allows you to be physically present in the market without being emotionally tethered to its immediate whims. It is your reconnaissance unit, sent forward to test the defenses of the trend before you commit the main force. The purpose is to establish a stake that is large enough to feel the pressure, but small enough that any immediate loss is merely a tuition fee. You must always maintain detachment from the capital, and the 1/8 position guarantees this distance. The amateur believes that 1/8 sizing is only for scaling into an already winning position. This is a false premise that will cost you critical entry timing. The true power of the fractional position is its ability to facilitate optimal, anxiety-free entry initiation when the setup is forming, but unconfirmed. You are buying time and mental space by entering small. The 1/8 position is your allowance to be wrong without being ruined. It is the tactical admission that you do not know the immediate future, but you demand a front-row seat to the unfolding action. This method removes the paralysis of waiting for the perfect setup that never arrives. Observe the actions of the aggressive, untrained trader. They enter big, hoping to catch the explosive move, and then they lose small, constantly taking minor hits that compound into substantial loss. The disciplined professional operates under the inverse initiation paradox. We enter small to test the market's conviction, and we wait to scale big only after the market has confirmed our initial thesis. They risk everything for a quick gain. We risk almost nothing to secure the right to eventually risk everything on a confirmed trend. This is the difference between a gambler and a speculator. Never confuse high conviction with high initial commitment. Every dollar you make in the market comes down to one core mandate. Successful speculation hinges on mastering the dual law of when to initiate and when to wait. Initiation is the commitment of capital. Waiting is the commitment of discipline. Most fail because they initiate when they should be waiting, and they wait when the signal demands immediate initiation. The market pays those who are patient enough to wait for the highest probability moments. It then pays those who are decisive enough to act only when that moment arrives, starting with the minimal stake. This brings us to the law of the probe. You must initiate that initial 1/8 size only when the chart structure suggests strong potential, but critically lacks momentum confirmation. The stock is basing out, forming a clear accumulation pattern, or is holding a significant historical level with volume reduction. The setup is theoretically sound, but the market has not yet decided to move. Initiating with 1/8 here is not an aggressive act. It is a defensive move to secure a base price. You are testing the waters, acknowledging the potential turning point without betting your entire stack on a hopeful turn. The market will tell you if your timing is correct. Your small position keeps you receptive to that truth. A successful probe confirms the structural integrity before the momentum arrives. Conviction is a measurable metric, and you must treat it as such. When your analysis, based on volume and price action alone, generates a conviction level below 60%, you must impose the uncertainty rule. Under this rule, the maximum allowable size for entry initiation is strictly 1/8. If you cannot justify a 60% probability of success, you have no business committing more than reconnaissance capital. The market has too many variables for any setup to be a 100% lock. but below 60% is a sign that the structural clarity is insufficient. This rule protects you from the emotional desire to trade simply because you are watching the screen. Never allow hope to dictate your size. Let the structural evidence be the only master. The small position maintains the necessary distance between your emotion and your capital. Discipline is defined by what you do after the initial probe. Always wait for a clear break and retest or definitive volume confirmation before you entertain increasing size beyond 1/8. The initial probe must succeed on its own merit before it earns the right to multiply its commitment. A successful breakout followed by a retest of the broken level is the market's clear invitation to participate seriously. Similarly, a surge of buying volume confirming the direction is a signal that institutional money is moving in your favor. If you scale too quickly, you turn a tactical probe into a premature commitment that can be easily stopped out. Never scale into a position that has not proven its foundation. Wait for the market to confirm your analysis before you reward it with your capital. The confirmation jump is the first moment of professional execution, requiring clinical precision. You may scale up to 1/4 size only after the initial 1/8 position has shown a clear 0.5 hour profit and has demonstrated it can hold structural support. Profit is not just money. It is the market's agreement with your initial assessment. Holding structural support confirms that the selling or buying pressure has been absorbed at a key level. This is the moment you double your commitment, transforming the reconnaissance mission into a committed skirmish. Never scale based on a feeling or an arbitrary time frame. Scale only when the market has literally paid you to increase your risk exposure. This process ensures you're using the market's money to fund your later larger positions. Every price chart is a battlefield with predetermined supply and demand fortifications. The professional speculator avoids direct confrontation with these established high-traffic zones. Never initiate even the 1/8 size directly into prior supply or demand zones that the price has not yet clearly absorbed. Initiating into a red zone is equivalent to marching directly into enemy cannon fire. The probability of immediate reversal is too high. You use the 1/8 probe to initiate ahead of the zone, or to test the weakness after. The zone has been pierced. Your job is to find the path of least resistance, not to engage in unnecessary high-friction battles. Patience dictates that you wait for the market to clear its own obstacles before you commit your capital. The red zone is for exiting. The clear field is for initiating. The 1/8 probe acts as an invaluable failure filter, saving you significant capital in the long run. If that minimal 1/8 probe immediately violates your predefined stop-loss criteria, you must treat the entire trade setup as structurally invalid. There is no second-guessing or widening the stop. The market gave you an immediate no. Your timing was off, or the perceived structure was a false flag. The loss on the 1/8 is minimal, a cheap lesson to learn the immediate truth. Do not cling to a failed thesis by re-entering or increasing size. Cut the position instantly and move on to the next opportunity. The purpose of the probe is not just to win, it is also to fail cheaply and efficiently. The amateur is constantly tormented by the fear of missing out, or FOMO. This destructive emotion forces them to jump in with too much size, guaranteeing anxiety and poor execution. The great secret of 1/8 initiation is that it removes this debilitating fear entirely. By entering small, you gain immediate low-risk participation in the potential move. You are physically in the trade, which satisfies the psychological need for action without placing your capital in jeopardy. FOMO disappears the moment your order is filled, regardless of the size. This allows you to observe the subsequent price action with clinical objectivity. You are no longer watching from the sidelines. You are participating without emotional stress. The second psychological law of position sizing is critical for long-term survival. The small size of the 1/8 probe ensures that your analysis remains objective. You are trading the chart, not the commitment of capital. When a trader commits too much size, their primary focus immediately shifts from analyzing the market to defending their rapidly shrinking equity. They become emotionally attached to the trade's success. The 1/8 size keeps the commitment so minor that you can still execute your stop-loss and scaling plans without hesitation or emotional argument. Your mind must be focused solely on the truth of the price action. Never let the size of your position overrule the truth revealed by the chart. Tight consolidations and ranges are periods of market indecision, often preceding explosive moves. This is the perfect environment for the 1/8 sizing strategy. You use this minimal sizing to test the boundaries of these tight ranges, establishing a low-risk baseline position that anticipates the break. Your goal is to secure a foothold near the pivot point, positioning yourself for the eventual expansion of the range. If the consolidation continues, the small position costs you little. If the price breaks out, your established position gives you the psychological and price advantage needed for aggressive scaling. Never bet big on the break. Bet small to secure the ideal entry price before the break. This patient positioning is the mark of a seasoned speculator. Catching a reversal is often the most profitable yet riskiest operation in speculation. The trend reversal law dictates clinical waiting. You must wait for the first confirmed higher low in a potential uptrend or the first confirmed lower high in a potential downtrend before you initiate even the 1/8 size. Do not attempt to catch the falling knife or sell the absolute top. Wait for the market to signal its internal structure has changed from kinetic momentum to structural rotation. The first higher low confirms that buyers have stepped in at an increased price level. This is your high probability signal for the initial probe. Initiating before this structural confirmation is guesswork. Initiating after it is high probability speculation. Capital must be active capital, not dormant capital trapped in inaction. If your initial 1/8 position drifts neutrally for an extended period, failing to hit the stop but also failing to generate momentum, you must treat it as a timing error and exit. This is the time stop rule. A trade that goes nowhere is tying up margin and mental capacity that could be deployed elsewhere. The goal is decisive action, not prolonged stagnation. Do not confuse structural patience with passive inertia. A setup that fails to move within a reasonable, predefined time frame has likely lost its internal energy. Exit the position to preserve your mental and financial capital for the next, more decisive opportunity. Volatility is a tax on uncertainty, and it must be managed with precision. When market volatility is unusually high, you still use the 1/8 probe size to initiate. However, you must simultaneously increase the price distance required for subsequent scale-ins. High volatility means that the required confirmation takes more price action to prove itself. A 0.5 R profit in a low volatility environment might be a minor move in high volatility. You must demand more proof from the market before you commit more capital. The initial risk exposure remains minimal, but the required evidence for commitment must be substantial. Never mistake erratic, volatile price action for confirmed momentum. The ultimate objective of position management is the removal of risk exposure as quickly as possible. You must move the 1/8 entry stop to break even immediately upon achieving 1 R of profit. This is the zero-risk mandate. Once you have secured a profit equivalent to your initial risk, the trade is no longer costing you money. It is costing you only opportunity. This move secures the most critical mental edge. The trade is now emotionally free. You can observe the subsequent action with total detachment, allowing the potential profit to run without the stress of principal risk. The professional's job is to manage the downside. The market's job is to produce the upside. Secure the principal and let the market work. The temptation to preempt a trade is constant, driven by impatience and the desire for action. I tell you this truth. Waiting for the high probability trigger signal always offers a superior risk-reward profile compared to preempting with even the 1/8 sizing preemption, captures a slightly better price at the cost of significantly higher uncertainty. Waiting sacrifices a few ticks of entry price but drastically increases the probability of a successful, immediately profitable trend. The small entry is a tool for testing certainty, not for avoiding patience. Never compromise your risk-reward potential simply to be first. The market pays the patient a premium for their discipline. Every trade, even the smallest 1/8 probe, must pass a cold, hard filter. You must only initiate that minimal probe if the minimum calculated risk-to-reward potential of the full trade exceeds 2.5 to 1. If the structural target does not offer 2.5 times the initial risk, the opportunity is fundamentally too small to warrant your focus. Speculation is a game of probability weighted by reward. A 50% probability trade with a 3 to 1 RR is infinitely superior to a 70% probability trade with a 1 to 1 RR. The 1/8 size is the ticket to entry, but the RR is the license to trade. Never waste your capital or your focus on setups that cannot generate significant returns relative to the risk. We arrive at the unified theory of professional speculation. The 1/8 sizing methodology is the ultimate technique for risk management that is cleverly disguised as a tactical entry strategy. It is not about how you enter. It is about how much you risk on an unproven idea. This fractional approach protects your capital while ensuring you are present for the opportunity. When should you initiate? Initiate the probe when the structure is clearly forming, but the necessary volume and momentum are absent. This is the moment where the premium risk is earned, securing the best price. You are positioning yourself for the truth the market will soon reveal. When must you wait? Wait when the market momentum is chaotic or when the price is directly battling major predetermined structural obstacles. You are the sniper, not the frontline soldier. You wait for a clear shot, not a crowded melee. The professional's career is built on the compounding principle, not on the heroic home run. Consistent clinical application of this fractional sizing discipline minimizes damaging drawdowns and maximizes the compound growth of your equity. You must treat every fractional entry as the defense of your future gains. Do not obsess over the massive winner. Focus on the precise execution. True mastery of trading is defined not by how much you make on a winning trade, but by the discipline of your initiation timing and subsequent position management. The professional's edge is built on small, calculated risks that earn the right to become big, managed positions. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content. And it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game I am talking about, Reminiscences of a Stock Operator. It is not historical, it is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.